Okay, let's just jump right in. It's early 2026, and if you just look at the surface, the crypto market seems unstoppable. I mean, prices are way up, and for the first time ever, politicians in Washington are actually being, well, friendly. But what if all of that is just a big distraction? What if the real story, the one that actually matters, is something else entirely? And all this good news is really just a trap.
So look at this. Bitcoin is cruising above $93,000, right near its all-time high. The whole market is optimistic, right? People are feeling good, and that brutal bear market feels like a lifetime ago. On the face of it, it looks like the party is just getting started.
And then you've got Washington. For the first time, they actually seem to be on board. We've got big pieces of legislation like the Clarity Act that are actually moving forward. They're trying to end that ridiculous turf war between the SEC and the CFTC and just bring some clear rules to the table. The entire vibe has flipped from hostile to, well, almost helpful.
So here's the puzzle we've got to piece together. High prices, friendly regulators. This should be the perfect storm for a massive sustained rally, right? So why are there so many red flags popping up just under the surface? Why do the fundamentals seem to be telling a totally different and, frankly, a much darker story?
All right, so let's start peeling back the layers here. The very first crack in this happy, bullish story comes from the one place we probably should have looked first: history.
You see, Bitcoin's price has followed this weirdly predictable 4-year cycle. It all kicks off with the halving, which is just a scheduled event that slashes the new supply of Bitcoin in half. That supply shock tends to kick off a huge bull run about a year later, which leads to some crazy euphoric peak, like the one we saw back in October of 2025. And what always, and I mean always, comes after that party? The hangover, a long, painful correction.
And that's the problem. If that cycle holds, then 2026 isn't supposed to be a year of new highs. It's supposed to be the come-down year. Just based on this historical pattern, you've got analysts out there predicting a drop below $50,000. That's a huge fall from where things are now. And that's our first big warning sign.
Okay, so the history is a little worrying, but this next red flag, it comes from the very people who should be the most bullish on Bitcoin, the miners, the people who literally create it. You'd think they'd be popping champagne with these high prices, but the data shows something completely shocking.
This is just wild. At Bitcoin's absolute peak, over 126 grand, the average public miner was spending almost $138,000 just to create one coin. Let that sink in. Even at the height of the market frenzy, the fundamental business of making Bitcoin was a money-losing operation for the average guy. Insiders are calling it the toughest profit squeeze in the industry's history.
So, what do you do when your main business is losing money? You get out. And that's exactly what miners are doing. They're scrambling to get into more profitable businesses like AI, signing these massive multi-billion-dollar deals with the big tech giants. Some, like Bitfarms, are even planning to quit Bitcoin mining entirely. And to pay for all this, their debt has exploded, a 6-fold increase in just 1 year. You have to ask yourself, when the insiders are running for the exits, what do they know that we don't?
The warning signs aren't just in the economics either. They're actually buried deep in the tech itself. I'm talking about these layer 2s, systems built on top of blockchains to make them faster and cheaper. They sound great, but they're creating this really dangerous centralization trap that most people don't even realize exists.
You can think about it like this. In any system, you've got 3 groups of people: the ones who benefit, the ones who make the rules, and the ones who take all the risk. Now, ideally, those 3 circles overlap. The people making the rules should have some skin in the game, right? They should feel the pain if things go wrong. But in these new crypto scaling solutions, well, that's just not what's happening.
You hear the marketing pitch all the time. Layer 2s are just as secure as the main blockchain. But researchers are putting up a huge red flag here. They're saying that's a dangerous oversimplification. What's really happening is these systems are bringing back trusted middlemen, creating single points of failure, and basically undoing the whole decentralization thing that makes crypto valuable in the first place.
And here's the proof. A staggering 86% of these scaling systems can be upgraded instantly by the people who run them. So what does that mean for you? It means the team can change the rules of the entire system at any time without any warning. They could change the code to steal funds, and you'd have 0 time to react or get your money out. It's a hidden backdoor that most users have no idea is even there.
Okay, so we've got scary historical cycles, miners who are losing money, and hidden tech risks. It's a lot. It's a really confusing picture. But there's one theory from former BitMEX CEO Arthur Hayes that just cuts through all of this confusion and gives us one single, powerful answer for what's really going on.
So here's the core idea from Hayes. He says, basically, forget everything else. The regulations, that's just political theater. The market cycles, just echoes of the past. The only thing that actually moves the price of crypto is how fast central banks are printing money. It's all about global liquidity. Are they pumping cash into the system, or are they sucking it out? According to him, that's the only question that matters.
But here's the really clever part. The central banks know they can't just come out and say, hey, we're printing trillions of dollars again. The public is wise to that now. They know quantitative easing means inflation. So they disguise it. They give it a super boring technical name like the Reserve Management Program. It's designed to make your eyes glaze over. But Hayes says it's the exact same thing. The money printer going, brr, in disguise.
And this is why they have to do it no matter who's in charge. Politicians are stuck in a trap. They know voters hate inflation, but you know what voters hate even more? Recessions. They will reliably vote out anyone who oversees a bad economy. So to keep the economy going and stay in power, they have no choice but to juice the system with more liquidity. It's a political reality that all but guarantees the money printer will never truly stop.
So if that's true, where does that leave us? Well, it means we need to stop paying attention to all the confusing, contradictory headlines and start watching the one scoreboard that actually counts.
Think about it like this. All the stuff we've been talking about, the new laws, the political fighting, even the historical cycles and what the miners are doing, that's all just noise. It's designed to distract and confuse you. The one true signal, the only thing that really matters, is global liquidity. Are the world's central banks printing or aren't?
So here it is, the bottom line. If you really want to know where crypto is going, you've got to ignore the news. Instead, watch the balance sheets of the big four central banks, the US Fed, the European Central Bank, the People's Bank of China, and the Bank of Japan. If those balance sheets are getting bigger, it means money is flowing into assets like Bitcoin. If they're shrinking, money's leaving, and prices are going to fall. It really might be that simple.
So that leaves us with one last question, and this one's for you. In a market that's filled with good news and friendly laws that might just be a trap, you now have a different way to look at things. You have a new lens to see through all the confusion. So the choice is yours. In 2026, are you going to be watching the noise, or are you going to be watching the signal?